Okay. Viewers, thanks for tuning into this edition of The Talking Point. I'm your host, Neeraj Shah, and we are in conversation today with Jinesh Gopani of Axis AMC. Jinesh, so good having you. Thanks so much for joining in. And,
Thank you.
it's an opportune time to have you, Jinesh, simply because so much has happened. We've had what is arguably a fantastic quarter three earnings season. There are some conversations around rising yields in the US and what that could do to risk aversion or otherwise and liquidity thereof. And I think multiple surveys have been done of late, which also suggest that fund managers still believe that the recovery will be V-shaped and therefore the risk appetite would continue. Let's start off with your belief about the risk appetite for equities, both globally and locally.
So, Neeraj, hi. You are absolutely right that there are concerns around US 10-year GSEC now moving towards 1.35 odd levels. And if it inches further higher, along with, let's say, if the DXY also starts moving up, then there would be a concern of reversal of flows, which might come. Uh, I don't know how it will happen, when it will happen, and but obviously the U.S. economy, the numbers are looking up pretty good after the stimulus packages announced. However, in March also they are now looking at one more big dose of stimulus. So it is very tricky. Next, let's say 15 to 25 days is going to be very tricky. Uh, if let's say the DXY holds on to these levels and moves down, then I think that reversal might not come. But if there is a sharp spike in both yields and the DXY, then I think you will have a knee-jerk reaction. And normally, if you see the history, March has always been like this. Something or the other as an event keeps on impacting the global markets. So we have to be cautious, I would say. And from India point of view, also after a stellar run before the budget, and at the same time after the budget, you had that good run of I think 12 odd percent now from the day of the budget, and you had close to 20,000 crores of FII investment already coming into India. So I think to that extent, you need to be a bit cautious on the near term side. But as you rightly said, the Q2, Q3 numbers have been much better than the expectation. As the COVID crisis came down, I think recovery of the economy was pretty sharp, and it was much better than anyone's estimates. And hence, if you really see, the Q3 numbers have been also better than the consensus estimate. One thing which has happened in this entire process of last 10 months is the massive shift from unorganized to organized companies, and that is where the listed companies have done incredibly well by gaining market share, by cutting costs, improving margins, and holding on to the overall balance sheet strength. They have been able to raise capital also wherever required, and that has really helped them to really become stronger in the sectors where they are. Whereas the unorganized player, unfortunately, is in I think genuinely deep trouble, and and be it a liquidity issue, labor issue, non-availability of raw material issue, cost of raw materials going up, which is not allowing them to do good business, availability of cargoes if they are importing raw materials. So all sorts of issues have impacted the unorganized, who are more, let's say, a mid-size SMEs or a small SMEs. And the entire market share shift has moved to organized players, and hence maybe you may say that everything is not good on the economy side if you really talk to many people. But markets are where they are because the listed players have demonstrated good ability in terms of earnings growth.
So here's my question then, Jinesh. If the money is positioned for upsides, right? Um, can a slightly nasty surprise on yields and DXY, a factor that you spoke about, could that reverse flows one, and can that have a large impact on markets? That is part one of my question. Part two of my question is also this chatter that has started to emanate around a resurgence of cases of sorts, especially in the state that we are in, which is Maharashtra, but maybe some of the other places as well. Can that kind of hurt the largely long only positioning that almost everybody seems to be having right now?
Just to answer your second question first, I think clearly we don't want second wave or a third wave kind of a situation. Hopefully, the vaccination process will get further accentuated, and we just hope that we don't get into the trouble like what happened in the developed world. When after the economy opened up, suddenly there were surge in cases. So uh, uh, it doesn't look like that we are in a very grim kind of a situation, but you never know. So that is a risk you run. If there is a second wave of COVID or a third wave of COVID into major cities, then and if there are, let's say, restrictions and lockdowns which are initiated, then I think not good from the economic momentum point of view.
And not good from markets perspective too. Would you think?
Obviously, so I think, see, everything is linked to earnings growth, everything is linked to economic momentum continuing. So that sudden jerk might take markets down. To answer your first question clearly, Neeraj, uh, and as I've been saying for last many months, is volatility is your friend. There is very fast positive attitude in the market and very fast negative attitudes which also start creeping in. So you would have seen before the budget, markets fell by almost 4-5% because of the issues around hedge funds. And after the budget, when budget was good and there was no significant negative surprises, I think everything got recovered in just 2 days time. Market was up 6-7% in just 2 days. So everything is getting factored in also pretty fast. Either it is negative or positive. So that volatility is going to be around. Volatility is will be your friend. So hence we have to be cautious and careful rather than getting into a mode of excessive momentum where sudden shocks can really take your stock prices down.
Mhm. Jinesh, do you guys take cash calls at all, or are you always fully invested?
So let's say it all depends on the situation. If let's say you are staring at second wave and genuinely things are going bad, then we might get into some kind of a cash call like 4-5% something.
But you're not
Or
cash right now.
we are sitting on 1.5% cash.
Well,
So see, I think from a longer term point of view, Neeraj, genuinely after this budget and as the economy has rebound,
yeah.
ideally, if there are no black swan events, things are looking good for next 2-3 years.
No,
So
I
we
was
are
I was gonna
long
come
term.
to the longer term. I was just gonna come to the longer term. I was just trying to see when a large AMC like you is the large AMC like you taking a tactical call about being on cash or no. I was going to come to the long term. I just wanted that short term idea from you.
See, frankly, cash just helps you that it is like a dry powder, and if the market's correct, you participate in that. Otherwise, cash doesn't help you on the outperformance or the
That's
underperformance.
that's Okay, so now let's focus on the slightly longer term. Two things that have gone by, Jinesh, and I would want to talk about two or three sectors in detail, but just one overarching view on how do you think earnings and market potential is positioned after what was arguably a really good budget from a markets perspective and economic perspective, and what has been a, a fairly decent quarter three season as well.
See, I think again, Neeraj, it all depends if the momentum of this economy continues. Uh, and next year, if we have a nominal GDP growth rate of 14-15%, then I think it could be a great run because people will roll over to FY23 and then will start valuing companies on those metrics. Uh, uh, if let's say if economic momentum slows down for whatever reason, then if you really see, always we start with 20% earnings growth and then we come down to single digits. So hopefully we don't want that. You have just come out of I would say once in 100-year kind of an event. So you don't want shocks again and again. Last 4-5 years, if you really see, the Indian markets have gone through 4 or 5 shocks. You started with demonetization, You started with GST, you had IL&FS crisis, liquidity issues on the financial side, and then you had now COVID coming into play. So we just hope that next 2 3 years are a stable years where the growth momentum really picks up what we used to have during earlier times without any shocks. And if that continues, then I think we will get loads of inflows from the global market, because really after China, India is a genuinely a big market for investors to participate. However, as I said, there would be near-term outflows if the yields go up, and if see those near-term uh, opportunities when to buy on dips will come. So there is no need to be in a hurry to just go and latch it on to everything, and every day there are new stories going around. Uh, Objectively, if you really see next 3 years, does it look good? Yes, if economic momentum is strong.
Yeah, I think we'll watch out for that. So, Jinesh, when I look at the positioning that you guys have done right in your portfolios, and I was looking at the sample of holdings in one of your schemes, of course, which is the Access Long-Term Equity Fund, which I believe you directly manage as well. Even though you are head of equities, you probably directly oversee this one too and some others. But when I was looking at this one, I mean, there's a large peppering of financials, and I think high quality private financials and consumers in this. So let's talk about both of these themes if we can in detail.
Sure.
Financials first.
Yeah.
There's a lot of fear about NPAs and permanent losses, what have you, which the financials will come in. And then the RBI came in, did a series of measures. Some of it is provided for. There might be some surprises as well. How do you see the next 12 to 24 months? Do you reckon that the high quality ones, which didn't have as much of a bump as well, would probably continue to outperform? Or is there an argument, for example, today that Morgan Stanley is making, that some of these NBFCs and maybe a large PSU bank like SBI, etc., could really give outsized returns because the valuations are so cheap? How do you see this one?
See, I think first is we have to see how each and every company on the financial side has come out of this COVID. And before COVID also, what they were doing on the business model front. So the first one to come out are the companies who have been able, who are, let's say, more emphasize on the risk management of the business model. And and also we are very happy that most of the companies where we are invested before COVID, they all came out with very solid, uh, I would say, understandings on the asset quality front, and also providing for that much in advance. Some of the companies also were able to raise capital at a higher valuation, which is again a good sign because dilution for the minority shareholders is less. Uh, so I think the first leg of move is always with the leaders. Uh, Fortunately for them, what has happened is, as you would appreciate, they are still very small in terms of market share on the asset and the liability side. And once you have come out of this problem with superior risk management system, and also now they embracing on new age technology, which really helps provide convenience to their customer. I think the market share gain story is going to be significant, and that is why the prices where they are now, because the markets understand that these guys can deliver, let's say, 2x or 3x of industry credit growth, higher than industry credit growth, and deliver on uh, high ROEs or ROAs based upon their business model. And credit cost, obviously, hopefully, if again, I should say that if there is no second wave, there are no lockdowns. That is a caveat, I would say. Economy has to run now smoothly, steadily. Then these guys will really deliver on high ROAs and ROEs. The second leg comes to some of the tier two companies who are, let's say, turning around, where there is a change in guard. There is some hope of turning around on the business model itself, having provided heavily. So obviously, if they are trading at one time price to book, always you can make a case for 1.5 or 2 time price to book, depending on the ROEs, ROA. but I would say leader will make larger profit pools, and given their ability to manage the cost of funds, uh, it would be very difficult for the others to really dislodge them and move up. But obviously, from a valuation point of view, from a turning around story point of view, you can make argument that there are some companies who are who have provided for the NPS, and there is a time that one should look into it.
Okay. There is a counter view that some of the optimists have, Jinesh, and I wonder how would you react to it, and which is that go out for the state-owned enterprises on the financial side. One, because while they have consistently lost market share, now with a bad bank and a DFI, what the government is implying is that the wholesale lending business is being taken out from them, and they don't have to get into infrastructure loans and the tough part of the business. They get to do what the private banks were doing hitherto, and with the kind of network that they have, access to funds that they have, cost of funds that they have, they might actually be able to put up a fight, because the trust factor in these banks is certainly there in large parts of the country, and there's a valuation which is in favor of them. And therefore, if that is the story that is being sold, and if people latch on to that story, can the returns, the stock price returns of some of the state-owned banks be better than the high quality financials over the course of the next 3 years or
So I
5 years?
think, I think obviously there is a case that there are one or two state-owned banks who are genuinely better. But if you really see what has happened, you leave aside. I'm not going into stock specific, but I'm just trying to say you leave aside the big PSU bank, which is best, I would say, among the lot. The rest have gone into consolidation. The rest have gone into mergers. So we'll have to really see the outcome of that, because those mergers have happened over the last 12 months only. So you don't know the real what is coming out of it. So obviously, the bad bank is a great concept. It will help declog some of the asset quality issues from these state-owned banks, and then they can focus on growth. But obviously, we'll have to see how that really pans out, and then what kind of measures they take to grow. Whether they grow, they again grow in the corporate side of the book, which is like or they go into home loan, or they go into retail. Uh, and see, at the end of the day, technology is going to play a very, very big role. So, where I would say they are still behind. So they would really need to invest heavily. But so if you see, I'm not saying that it's a no, but obviously we also have one large public sector bank in our one of some of our portfolios. So obviously the best way to play is that entity. The rest, I think we'll have to go step by step. How fast these ARCs form, how fast they are able to change. Sorry,
That's
how
okay.
fast they are able to change the technology piece, the people problem which is around. So I think it is going to be a long term journey. So if you want to take a view and you are happy to sit with 2 to 3 year view, then obviously some of banks will still make sense.
Got it. Viewers, please remember
Like,
standard disclaimer.
I buy at one time price to book some NBFC, tier 2 NBFC, or I buy one time price to book some public sector banks. So
Yeah.
means money is not infinite. So
Yeah, that's a very pertinent point. And viewers, I just wanted to make a standard disclaimer: none of the things that are being discussed are recommendations of any nature whatsoever. I think Mr. Gopani is just being using them as examples to make his point and explain his point better. Which
also we have to keep in mind. Also we have to keep in mind the inflation part, how the oil prices move, how the interest rate moves. So these are all consideration to be kept in mind when you are really looking at, because see, at the end of the day, if you get into trouble of inflation, then the story might reverse also pretty fast.
yeah, that's a very important point to keep in mind too. Okay. So Jinesh, just one small clarity though. So are you saying that because capital is finite, you would believe that from a investing perspective, some of the cheaper NBFCs might give you a better and safer bang for the buck than the state-owned banks?
See, I think it is. I would say if you get it right, then the chance of making money would be humongous. Because what happens, unfortunately, as I said, that if the interest rate starts moving up, or let's say oil prices goes to 75 $80,
Yeah, sure.
then there could be a huge sell off because of the fear of bond losses and everything.
Got it. Okay, sure. Jinesh, last couple of questions. The other one is on consumers, and you have a large peppering of there too. So, can you talk a bit about that? Because one can safely assume that staples, for example, didn't get impacted at all during this whole COVID thing as well, or largely didn't get impacted. The discretionary consumption plays got impacted. Some of the business models are probably altered permanently. So, therefore, how do you figure out within the landscape what is good to keep large money in the current juncture from a next 2 3 year perspective?
See, I think clearly consumption as a theme is a very, very long term theme. If you really see, because India is a domestic consumption driven economy. So anything which happens for good for India, ultimately it will get into a consumption. Because you are whatever infrastructure spends or whatever facilitation of this infrastructure is happening is to improve life of the individual. And once your per capita income starts improving as your job growth improves, he or she will end up start consuming more. And that is the story of India, like what US was, let's say, 20 years back. So consumption is a very long term story. Identify 2 3 good names who can stay on course, on free cash flow side, on business moat side, for a longer period of time, and just sit with it with a longer term view. Because near term it might be a possibility that they might not do well, because there is a sort of a money shifting towards infra proxies, I would say. And we are also doing in some sense. So we are also trimming down some of the consumer names and pharmaceutical names, and trying to look into some of the stories which can really benefit in on the cyclical side. So be it cement sector, or be it home improvement, building improvement, or anything like that. So obviously you need to diversify some part of the portfolio, just to ensure that the way the investments will happen over next 12 to 18-month period, you don't miss out on that. So be it capital goods or something like that. But consumption as a theme, from a longer term perspective, is a very, very, I would say, stable and steady theme. Companies keep on delivering high free cash flows, and they keep on giving it to the shareholders in a big way. So you certainly should have some part of your portfolio into consumption, because we should not forget that India is all about consumption
Yeah,
more, as compared to China, which is more about exports more. So
that's true. Okay, the final question then, since you brought it up, Jinesh, just a thought on infra proxies or infrastructure, because usually while the spend on infrastructure may be high, the pure play infra creating companies don't create wealth, unfortunately. So how does one play these?
I think it is tough in India to play infrastructure, if you want to play as a basket in a big way, because obviously there are lot many hurdles around. And as I said, it starts from availability of land, uh, what kind of project it is coming, and how the projects will get awarded, how the funding happens to that project, and the gestation period is just too long. Uh, and also IRRs, at least what we have seen over last 10, 12 years, the IRRs are in single digits.
Right.
So the best way to play, at least from our point of view, is to play infra proxies. So play it through steel, cement, or capital goods, or home improvement, or building materials. Because at the end of the day, infrastructure is a facilitator for the improvement of the society.
Right.
So ultimately everyone will benefit. Obviously the time frames might be different, but at the end of the day all benefit. And if you can pick and choose some stories on the capital good side, or from the cement side, or from the steel, or from the I would say home improvement side, or building material side, I think net you can create a good portfolio over next 3 to 5 years.
Okay, Jinesh, we leave it at that. Thank you so much for being with us today and giving us your thoughts.
Pleasure. Thank you very much.
Viewers, thanks for tuning into this show.